Good morning from our world headquarters in New York. I'm McNally.
And I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Markets price de-escalation as the U.S. and allies work to contain broader conflict between Israel and Iran.
Base metals surge following the U.S. and U.K. decision to impose sanctions on Russian supplies.
Apple's iPhone shipments tumble as the company struggles to sustain sales in China. Good morning. Monday morning, we're really trying to understand, are we in another move to reprice risk? There's also more to come on banks.
It is. It's a busy day, Manis. Whether it's repricing oil, whether it's repricing treasuries, it's the de-escalation that we're focusing on now.
Indeed, and that is manifest in oil, in treasuries, and in equities. Don't forget, last week was a pretty brutal week. The S&P 500 was down by 1.5%. We're now going for a mini bounce. The language from the United States is, according to Axios reporting, that Biden would not support a retaliatory strike by Israel on Iran. Cameron talks about think with your heart, not your head. So you are seeing this geopolitical narrative rise. Dan Ives has a cracking note. Danny, you shared that with me. Now is the time to buy the dip. A sell-off in tech is a buying opportunity. Keep an eye on Apple at the bottom of your screen, down 0.7% as their shipments fall by 9.6%. So again, this is about the first quarter and shipments are under pressure. Nasdaq trying to grapple with a bounce there. And stocks in Europe also up. Keep an eye on Adidas. Adidas really taking a monster bid this morning. You have Morgan Stanley double upgrade there. Overweight. Take advantage of the lull in Nike and €235. Danny.
Manis, it is remarkable the amount that oil has dropped this morning. It's only 1%, but this is the important thing to keep on mind. This is cheaper than where we were last Monday. It is cheaper than where we were 7 days ago when we were at $86 a barrel. We are just below $85 a barrel right now. It is the market treating this as the risk of escalation is over. You see that in treasuries, too, which were bid on Friday. That haven bid finally coming into the floor. We're still above 4.5%, but we're up about 4 basis points after the rally on Friday. Aluminum, that is trading at a record. This is LME aluminum. We're at $2,552, up some 2.33% after the U.S. and U.K. imposed new sanctions on Russia, saying to them, you cannot put new metals into the LME. But trading still happens beyond the LME, but of course it impacts prices there. So it is higher this morning, along with nickel at the same time, Manis. And you've got some breaking news.
A little bit of breaking news just carrying forward. We saw that shipments from Apple down, but this is on the chip side. Samsung, they're going to get $6.4 billion in grants for chips here in the United States of America. Now, the interesting thing here is, Danny, Samsung will not be tapping the CHIPS Act loans and guarantees. You remember Intel and Taiwan Semiconductor both went down that road. No, they are going to take advantage of some tax incentives. So it's going to be at 25% of the qualified capital expenditure. So it's about an exemption from tax they're going to build out in Texas. So this is a materially different incentive, but it is an incentive nonetheless of $6.4 billion, but it's not in the CHIPS Act. So we'll see how that plays out through the morning. There is Samsung Electronics over the space of a year.
So while we keep an eye on what Samsung does when it reopens tomorrow, what the rest of the chip space does, it is all about oil. It is about escalation and the risk that there is a material escalation. Manis, as we've been talking about, this market is not trading as if there will be an escalation. This is what Halima Croft says over at RBC, that the war may move down the escalation ladder if the Israeli government follows the advice of the White House and forgoes retaliatory action. The reporting from Axios, as you mentioned, Manis, is that the White House says they would not support Israel in a retaliationary act.
And we're going to catch up with Rapidan Energy a little bit later on, Bob McNally. And Bob's first take on the first piece on the top line of his note is this relief sell-off in crude is largely on, as he calls it, a flopped Iranian attack in the absence of an immediate Israeli response. And that is what the Brits and the Americans want to try and contain. We don't know where this goes. We don't know what the response mechanism will be.
Right. What we've heard from Israel so far, though, hasn't necessarily been one of we're steadfast in not responding. Benny Gantz, for example, said Israel will exact a price from Iran in a way and time that suits us. But Israel and its allies, Manis, did intercept most of the attack drones and missiles launched in Iran over the weekend. Prime Minister Netanyahu addressed the nation yesterday.
The state of Israel is strong. The IDF is strong. The public is strong. We appreciate the U.S. standing by Israel's side, as well as the support of Great Britain, France, and many other countries. I have set a clear principle. Whoever strikes us, we will strike him. We will defend ourselves against every threat, and we will do this calmly and with determination.
Bloomberg's Golnar Motivali joins us now, who covers the Middle East and Iran for us. Golnar, we have had messages. I mentioned Benny Gantz saying that we will respond in a way in time that suits us. Itamar Ben-Gvir, the national security minister, called for a crushing attack. I mean, that's not exactly language that Israel is just going to stand by and do nothing.
Yeah, I think that's right. I think in the same way that Iran had to respond to the Israeli strike on its consulate in Damascus. And by the same token, I think definitely the calculation in Israel is that it has to respond somehow. It can't allow a precedent to be set for sort of direct attacks from Iran to Israel, you know, despite the strength of the Iron Dome and the force of Israel's allies. I don't think they obviously want this to go unheeded. They can't. I think politically it's not something that they can just forego. But I think that reaction has to be very calibrated. We don't know what it's going to be. We know that they had a war cabinet meeting that was inconclusive. And I think right now Netanyahu is probably kind of having to balance these two very loud demands. One is from the extremists and hardliners in his own cabinet, like people like Itamar Ben-Gvir, and then on the other hand, by the Biden administration that, as you mentioned, has said that it won't support, reportedly said that it won't support a direct strike by Israel on Iran. So the reaction is going to be careful, but I think it's going to have to react somehow.
And, you know, this is where Cameron, you're based in the UK at the moment. Cameron said, I said at the start of the show, think with your heart, not with your head. But of course it is think with your head as well as your heart. That's what he said to Sky News. Ziad Daoud, our chief emerging market economist, said Iran designed its retaliation to cause maximum symbolism, but minimum damage. And the question is whether that damage permeates from the firing of missiles into attacks via the proxies in the Strait of Hormuz. There was a boat captured over the weekend. Oil is really batting this situation away at the moment, Golnar. Why?
Well, I think a lot of this was factored in, right? So we had a lot of noise diplomatically. Obviously, Bloomberg, we reported this story quite early on, that the Americans and the Europeans were definitely expecting a reaction from Iran within hours, within days. So we were expecting that on the weekend. We were all waiting for it. And then, of course, when it came to Saturday night, we knew when the drones were in the air. Israel was in a position where it could kind of count down the minutes to when these things were supposed to enter Israeli airspace. We even have reportedly Jordan intercepting one of these missiles, at least over Jordanian airspace. And we know that Iran, from our own reporting, flagged this and telegraphed this to its allies and those countries in the Middle East, and particularly in the Persian Gulf, like Saudi Arabia, like the UAE, that it's trying to mend bridges with recently. It's actually made an effort to be very transparent about what it was going to do. And that's why. So oil really priced this in, I think, before it happened.
And it's the sentiment I've seen in one or two notes, which is the message to Israel, which is to take this win. In other words, that defense mechanism happen. We understand there'll be other conversations with Bibi later on today, Schultz and Macron. We understand talking to the Israelis. Golnar, thank you very much. Bloomberg's Golnar Motivali. Other stories trending on your terminal this Monday morning. The German Chancellor Olaf Scholz has begun his second visit to China. He's expected to deliver the delicate message that Beijing has not acted on European warnings to end discriminatory business practices. Sources say Scholz wants to persuade the Chinese President Xi Jinping that he needs to act soon to avoid EU tariffs meant to rebalance the trade relationship.
Prime Minister Lee Hsien Loong of Singapore will step down May 15th as part of a long-planned succession, ending a two-decade run. Deputy Prime Minister Lawrence Wong will become the city-state's fourth premier the same day.
CVC has revived plans for an IPO in Amsterdam. The buyout giant seeking to raise at least 1.25 billion euros, with investors in a listing that potentially paves the way for other private equity firms to go public. Coming up, we'll dig deeper into this oil market post-Iran's attack. Bob McNally from Rapidan Energy joins us later this hour. First take.
But up next, we're going to catch up with TD's Mark McCormick on why he doesn't see much strength in the dollar until later this year. This is Bloomberg.
Bloomberg Brief. I'm McNally with Danny Berger here in New York. So Monday morning, what have you got? Well, the dollar is taking a small breather from a rally that it saw last week on the back of geopolitical concerns and the resilient U.S. economy. TD's Mark McCormick sounding the alarm, writing the following. The market has ignored the fact that growth data outside the U.S. converged with the U.S. These conditions create limits to the dollar rally and reinforces us with the most of the best trades are on the crosses in the near term. Mark joins us now. He is the head of Global FX and EM strategy at TD Securities. Mark, I look at G10 this morning. There is a definition of haven. It is the dollar this morning. I know that cross assets are trying to grapple with a de-escalation narrative, but it's interesting to see the dollar. It's not just got a row story, but it has that haven status. It's affirmed, isn't it?
Yeah, absolutely. The thing around the dollar is that it offers high carry. It does offer the liquidity of U.S. Treasury markets, and also at the same time, it's also a relatively decent growth story. So along with the geopolitical tensions we've seen and the push towards higher oil prices, we've also seen essentially higher inflation in the U.S. So these are all factors of last week that have really kind of worked in the dollar's favor, particularly against the G10 currencies that just don't have a lot of those factors. So the way we're kind of looking at it is if you kind of look at FX more broadly, there is a divergence between emerging markets where there's certain currencies that do well with higher inflation and higher oil and higher energy, and certain G10 markets which actually just don't do well in those environments either. So we do like some of the cross stories here, like Euro Brazil or Swiss versus yen, or even if we look in Asia, there's a lot of nice trades you can see, like funding out of renminbi into currencies that might do well in a favorable global growth environment like Korea.
Mark, I know you also write that year-end Q4, you might see some real strength actually coming from the dollar because of things like geopolitical risk, because of the election risk. Mark, is it not time to start pricing that in now if you look at what happened over the weekend, that risk is still very alive, and of course that's going to matter even more for an election and who's sitting in the White House?
Right. So I think a lot of it has to do with like first and second order effects. So the really interesting thing about the dollar is Q4 of last year was all about the growth convergence with the U.S. We see it in our models that the dollar was much more responsive to growth, which is why it sold off so aggressively. First quarter of this year, though, was really all about the acceleration of U.S. inflation. So what we did is we coined this basically, everyone talks about the dollar smile. This is almost like the dollar's inflation smile. So part of it, though, is we still believe in the disinflation narrative. Service inflation is driven primarily by wages. Wages are still kind of moving in the right direction. And also, if you think about what was very important from the CPI is housing. And if you look at the rents and some of the high frequency data, that should continue to deflate as well. So there's still scope here that the Fed can cut in the summer, which is what we're expecting, which allows the Fed to kind of move in the same direction as everyone else. So if we take our eye off the inflation narrative again and we move back towards the growth, I do think there's room to tactically kind of trade the weaker dollar through Q2 and Q3. But that's the first order effect. And then the second order is now we need to think a little bit more about the geopolitical risks, but we need to get past U.S. conventions, which are in the summer. We also need to kind of work through these macro drivers that are more important in the election, just given how far off it is.
Look, we'll come back to the divergence story because ultimately it comes down to whether you believe the Fed and the ECB are going to have a massive gulf between them. It sounds that you're saying perhaps not. I'm curious to know, I look at dollar yen, I look at geopolitical situations. We are far from done with understanding what the Iran-Israel conflict is. I look at dollar yen this morning, 153.76. That's the dollar rather than yen. That is dollar strength. But What are we not understanding about the Bank of Japan? I mean, it would typically be in periods like this that the yen is much stronger and better bid, and it just simply hasn't been.
Yeah, the Japanese yen's through, I'd say, the last couple of years has lost its properties around, a safe haven. Again, if you think about the nature of a safe haven, the most important safe haven we have right now is gold, which is why gold is running at $2,400 per ounce. I think a big part of it is markets aren't worried as much about a recession as they're worried about inflation. Mm-hmm. And again, if you think about the geopolitical risks that we have going on right now, this is inflationary. Largely, again, if there's any disruption to oil supply like we saw with Russia, Ukraine, 20% of the oil market basically runs through the Strait of Hormuz. So there's elements here that oil has been firmer because of positive demand, also the reopening of China, the moving around of the population a little bit more. You can think about jet fuel and things like that. But it's also driven by supply issues. So the yen is not primarily, I think, a great safe haven in this environment, largely, again, because most of the flows that are moving yen are Japanese institutional investors moving yen offshore. I think a big part of this here, though, is you have to kind of think about the more the yen weakens, and you're seeing this already in Asia, the Bank of Indonesia, you're seeing with the PBOC, they're trying to verbally intervene in the market, especially with their fixings. We're getting to the point where Asian central banks are very uncomfortable with weakness. So the further the dollar yen moves closer towards 153, 154, the more likely the Ministry of Finance is going to come in. They obviously want to have the asymmetric risk to kind of spook the market and catch it off guard. So there are also limits to the dollar strength just from the Asian stories where there is divergence on interest rate differentials. But another big part of this is that the BOJ, the more the yen weakens off, the more they're going to have to respond. Yes. Even if, again, if you poll a lot of investors ahead of the last hike, no one was expecting this to start the year.
Yeah, I mean, Kanda, the Japan's chief currency chief, has already been speaking this morning, saying that they're in frequent contact with FX officials abroad. They're arranging the first U.S.-Japan FinMin meeting with South Korea as well. Mark, we're going to have to end it there. Thank you so much for your time this morning. Mark McCormick of TD Securities. Mans, before we end the block, we got to talk about what metals are doing this morning. Roaring. Aluminum at a record. Surprisingly, copper's starting to come down, but aluminum up 2% off the back of new sanctions from the U.S. and UK saying Russian metals cannot be placed in the LME, at least new supply of Russian metal. Yeah,
I mean, this is what you call asphyxiation. You say aluminum, I say aluminium. And of course, in 2022, the LME themselves were considering banning Russian metal into the exchange. They decided not to. Where is the winner in this trade? Maybe it is China who gets to gorge on even more supply that will be diverted from LME into China. Gold is bid, as we just heard from Mark there, incredibly strong. And you have a nice big note out this morning from Goldman's, 2,700. Unshakable bull market in gold. We're going to talk about Apple. Less shakeable or not. This is Bloomberg.
It's Bloomberg Brief. I'm Danny Berger alongside Manish Krani in New York. Apple has had a tough start to the year. iPhone shipments have slid 10% in the first quarter. That's according to market tracker IDC. Its dominance in China continues to be challenged. On that, let's bring in Tom McKenzie, who joins us for more. And Tom, we had known that Apple was struggling in China. So how much worse are these numbers?
Yeah, you're absolutely right. There's been a drumbeat of bad news in the last few months, since the start of the year, really, about Apple's prospects, and all of it has come down, as you say, to China. You talk about the almost 10% drop, so that equates to about 50.1 million mobile phones that were shipped in that period. The expectations were that you'd be getting about 51.7 million. So you're talking about a drop of almost 2 million versus the estimates. It's the biggest drop that we've seen, in fact, since COVID-19 and all the snarled supply chains that impacted Apple then, of course. So it is significant. And again, to the China factor, the competition is real. You're seeing that from the likes of Xiaomi. You're seeing that from the likes of another company as well, another smartphone maker in China called Transient, coming out for some cut price phones there. Their market, their sales in the same period grew about 80%. Xiaomi's grew about 30%. This as Apple dropped about 10%. All at the same time as well as you get this ban coming through from China on people bringing in smartphones into companies, state-run companies, state-owned companies. So that's affecting, of course, millions of people in China as well. So the competition is there and the restrictions you're seeing in place, and it's starting to have an impact clearly on the sales of the smartphones, the Apple smartphones in China.
So what about the health of the overall market? I mean, is this an Apple malaise? Because the rest of the market seems to be doing grand, and on top of that, raising prices.
Well, that's it. The top line is that this market has rebounded from the struggles that it's faced in the last couple of years. It's been one of the best years, in fact, for a number of years for the smartphone market. You saw overall growth of almost 8%. Samsung remains number one. Apple's still holding that second place. That Xiaomi is catching up, though. And again, the growth that you're seeing, the pickup from a low base, of course, for the likes of Transsion and Xiaomi is something that is obviously going to concern Apple. Apple has the pricing power still. It is still commanding the highest prices in that market. But you're absolutely right to point out that the broader market is turning around. But for Apple, you're seeing that drop and that challenge continues. They're, of course, trying to ensure that they can build out supply chains in other countries like Vietnam. They're focused on India as well. So they want to build out their footprint there. But for now, the Chinese market remains a challenge for Apple as these competitors come to the fore.
Tom McKenzie on the Apple story, the pressure on Apple. The rest of the world benefits. Tom McKenzie. Coming up, we're going to talk about oil. But before that, Danny, let's just reflect. I mean, the geopolitical pressure on Israel is mounting. And we understand Macron is talking about a calibrated manner to Bibi.
Yep, and local media is reporting that Israel's war cabinet is set to convene yet again today. And the military has presented the government with possible responses to Iran. We're going to catch up with Bob McNally.
Welcome back to Bloomberg Brief. I'm Menace Crenny in New York.
And I'm Danny Berger. Here's what you need to know.
Markets price de-escalation as the U.S. and allies work to contain broader conflict between Israel and Iran.
Base metals surge following the U.S. and U.K.'s decision to impose sanctions on Russian supplies.
Apple's iPhone shipments tumble as the company struggles to sustain sales in China.
And more bank earnings are upon us. Goldman reports today, and Morgan Stanley and Bank of America tomorrow. Manus, it is remarkable that oil is trading just above $84 a barrel, despite all the calls we've had for $100 a barrel that have grown after this conflict.
It definitely is. It's a reset in price, but then it is de-escalation is the narrative. It's de-escalation across assets this morning. And will that hold? The Germans, the French, the Brits, alongside the Americans, are calling for a de-escalation.
Well, local reporting does suggest that the Israeli war cabinet will be meeting today. In the meantime, Manus, let me show you what oil is doing exactly. We have dropped by about 1%. We're down more than that at the moment, 1.2%, let's call it. But again, we are about $2 cheaper than where we started the week last week. It is a lower crude price, despite the conflict and the potential escalation and whether or not that's priced in. We're also seeing the 10-year yield. That's also reversing some of the losses we had on Friday. We're up by about 3 bips, over 4.5%. Meanwhile, aluminum trading at a record. This is after the U.S. and U.K. imposed new sanctions on Russia, saying new metals cannot make their way to the LME. The important thing about this, man, is to some degree that is symbolic. Plenty of non-U.S. entities can still trade Russian aluminum, nickel, and copper. You just can't store it at the LME. So sure, it matters for prices on the LME, but for the global metals trade, perhaps not as much.
Well, it certainly opens the floodgates for more supply going into China. In terms of these markets, we are trying to understand what is the next evolution of risk. De-escalation seems to be the narrative across assets. Stocks were down by 1.5% throughout last week. So we have this small bounce. Wedbush Security, Dan Ives says, take your opportunity on this drop in tech. Any drop in tech is something that you want to embrace and to buy any sell-off that there is. Of course, this quarter's earnings are going to be a major positive catalyst for tech, he says, and it has the capacity to rise by another 15%. We've got to wait and see what that war cabinet comes up with, because, of course, bonds really did behave as a haven on Friday. We give a few basis points back there this morning. Europe is up by 31%. Take a look at Adidas. I mean, what an amazing spike this morning. Morgan Stanley says take advantage of that lull, as it were, in Nike. The stock is up just under 5%. It's a double upgrade. They go to overweight and they go to 235 in terms of price. 204.60 is where we are at the moment. Danny.
Manus, a lot of what we're getting out of pricing that would be geopolitical risk, the confusion about it is it runs very counter to what has been the trend this year. That is disinflation, that is weaker dollar. And we heard that tension speaking with Mark McCormick of TD, who we had on just moments ago, saying that he was expecting a weaker dollar because of the disinflation narrative. But what happens if the price of oil goes higher? Or are you trading dollar as a haven?
And on that haven status and on the divergence trade, he feels that the dollar will drop a little bit later on in the back end of the year because we are overestimating. We're overestimating where the inflation narrative will go to. But look, we'll talk more about that FX story. And by the way, yen is not your haven that you all thought it was, as it traditionally was. Exactly. They've got a whole other issue to deal with in terms of the Bank of Japan. But let's talk about today, because there's a whole reset here in New York. Donald Trump is set to become the first former U.S. president to face a criminal trial. This comes as the Republican nominee is fighting his battle to retake the White House. She's here. She's in New York. It is Katie Lyons. Good to see you this morning. Welcome back to the set from whence you went. Talk to us. What kind of political and legal theatre will we get this week?
Well, quite a bit. This week maybe less so because it begins with jury selection today. They're going to try to find 12 jurors who can be unbiased in assessing not just the current presumptive Republican nominee, but a former president who they all likely know very well. So they will be asked things like whether they have a true social account, whether they've ever attended a Trump rally, as they try to find a dozen individuals who are going to be able to assess this case. Now, in this case, of course, what we're dealing with here is 34 felony counts that Trump has been charged with of falsifying business records. This is allegedly in attempts to conceal hush money payments paid to porn star Stormy Daniels just ahead of the 2016 election. And in doing so, according to prosecutors, he violated election law, which is what has raised this to a felony. Trump, of course, denies all of these charges. He has suggested potentially that he could be testifying himself in this case. We also will likely hear from witnesses, including potentially Stormy Daniels and Michael Cohen, his former attorney and fixer who made these payments to her in the first place. So certainly a lot of theater could be expected. These counts individually each could carry a maximum sentence of up to 4 years. So if he were to be convicted, there is the question of whether he would serve prison time. And of course, amid all of this, he's still going to be actively campaigning to once again retake the Oval Office and be president of the United States.
Right, because part of the question about him being convicted is not just what time, what punishment there potentially is, but what it means to potential Trump as president.
Exactly. Now, being convicted of a felony, surprisingly, would not actually prevent him from running for president or holding the office, but it could have implications for how likely people are to vote for him. On the one hand, this is every day he has to be in the courtroom except for Wednesdays. That's going to take him off the campaign trail. He is spending a lot of money on his legal defense, which drains campaign resources that could be spent elsewhere. But also the polling that Bloomberg has done together with Morning Consult suggests that in the 7 swing states that are very likely to decide the result of the election, more than half of voters say if Trump were to be convicted of a crime, they would not vote for him. So it could impact ultimately turnout and whether or not people are willing to cast a vote for him in November.
Well, it's certainly the world is watching in regards to what happens in Israel and Iran. And the National Security Council spokesman John Kirby spoke yesterday about the White House's response to Iran's attack.
The president's been very clear. We don't seek a war with Iran. We're not looking for escalation here. We will continue to help Israel defend itself.
So the debate is the war cabinet meets later today. Iran's attack on Israel was well telegraphed. The question is escalation, de-escalation risk. Katie, I mean, we've got global leaders now making it very, very clear. Emmanuel Macron talking about Iran's attack over the weekend, the response in a calibrated manner. We've had tweets from Foreign Minister David Cameron talking about the head and the heart and the recalibration. And the White House is not keen to wrap its arms around a further retaliatory escalation. Just quantify that for me, qualify that for me.
Well, what we've seen from this administration is they stand by their commitment, which they describe as ironclad, to support Israel's defense. And certainly we saw U.S. military forces acting defensively, helping shoot down those 300 drones and missiles over the weekend. What the U.S. seems less willing to support at this time is offense. Axios reported over the weekend that Biden, on the phone with Netanyahu, suggested that the U.S. would not join an offensive retaliatory attack against Iran because of those very concerns around escalation. Now, as we've seen with the Biden-Netanyahu relationship in recent months, which of course has grown more tense because of the ongoing operation in Gaza and the high civilian death toll that has been exacted there, there is tension in the relationship, and the administration has been really pushing Israel to have more restraint. That isn't always necessarily heeded. Ultimately, this decision is Israel's own, and so that's what adds the complication. Of course, this attack against Israel has fortified the idea that, yes, this is an alliance that the U.S. is standing behind, but the U.S. at this time is not really eager to see things escalate further in the Middle East.
Kayleigh, a busy day for you. Thank you for joining us, for getting up early. That's Bloomberg's Kayleigh Lines. So oil is dropping this morning after Iran's attack on Israel. Prices are slowly easing. And it really represents that this market is speculating that the conflict will remain contained. Let's get over to Bob McNally, founder of Rapidan Energy. Bob, this is an oil market that is now priced more cheaply than where we were on Monday before Iran attacked Israel. Is this market overlooking the odds of escalation?
Good morning, Danny. I think it is still. At Rapidan, we actually increased our odds of a material disruption from Arabian Gulf oil and gas flows from 30 to 40%. I would say the market's closer to something like 5%. But, you know, the sell-off today is pretty predictable and understandable. The high interception rate enabled the market to dodge a bullet. So I think it's understandable that we're soft today. Israel's going to take its time and enjoy the benefits, the strategic benefits of this weekend, especially in terms of a regional alliance that stood up and protected it. So it's going to take its time. The lack of casualties really enables Israel to take its time. But I think we're in an escalatory dynamic, a slow, steady, but sure escalatory dynamic. Israel has an agenda. It's not just Gaza. It needs to address its security risks in Lebanon and with Iran. And we're heading in that direction. And so the risk trajectory, we think, is still up.
Bob, good morning to you. In terms of where that escalation risk comes, it's more likely via the proxies. Do you think the risk, and you've focused on this in the Strait of Hormuz, do you think that that materially changes in terms of a risk element? There was a tanker attacked over the weekend. So are the odds of retaliatory Iran action now likely more to focus on the Strait of Hormuz, or do you think via the proxies?
I think, Manis, it's going to be two avenues. One is Iran's top proxy, the big one, Lebanese Hezbollah. Israel's determined, after Gaza is settled, to push Hezbollah away from its northern border. Unlike Hamas, Hezbollah is Iran's top proxy. They will defend it. So that's one avenue through the proxies. And then, as you mentioned, Iran seized an Israeli ship. Iran blamed the United States for Israel's action and explicitly warned over the weekend. President Biden said, you better rein in Israel or your bases will be attacked. So I think when we think about this shifting to the Middle East, there's two problems. One, the Strait of Hormuz, but let's not overly focus on just the Strait of Hormuz. There are key energy infrastructure facilities in the region, Abqaiq, Khurais, that have been attacked. Those are also targets that Iran could, and its proxies could hit again.
Bob, a political reporter tweeted this out. They haven't written a story about it, but she tweeted it out saying that one of the House bills expected to be brought up this week aims to make the Iran Sanctions Act of 1996 permanent, was set to sunset in 2026. So there is clear language, at least coming from Congress, about potential sanctions or keeping current sanctions for longer. What would that mean to oil if sanctions are now being brought up again and potentially taking Iranian oil off of the market?
So I think Congress is very angry, especially Republicans, that the president has more or less looked the other way and allow Iran's production, your colleague Javier Blas has pointed out, to get to very high levels. And so, but you know, when it comes to national security and issues like this, the White House has a lot of power. And I think the Senate also can stop this type of thing. So I think President Biden is still going to be in control. It's up to him whether the United States tightens enforcement on Iranian sanctions. I think the House bill might pass, but it's the Senate and the White House can probably slow it down this year anyway.
Bob, you say that this is a classic reaction in the oil market and that perhaps it will last for a short period of time, but you still fundamentally believe that we have a stronger demand in China and a tightening market and the ability of OPEC Plus to release even before the June meeting should it need to. So just extrapolate for us, do you think that we steady in this bandwidth 90 to 93 without a retaliatory action, a significant retaliatory action from Israel?
Yes, Manus. Rapidan models Brent fairly priced on a quarterly average basis in the high 80s, low 90s, as we sit here in a tightening market, well controlled by OPEC Plus, I must say. However, we do think geopolitical risk will add at least another $3 to $5 per barrel in the coming weeks, and probably more than that. And the problem is the high OPEC Plus spare production capacity, the buffer, is unfortunately inside the Arabian Gulf. It will not do us much help if this conflict expands regionally to include Iran. So it's balanced with strong upside risk, in our view, due to underappreciated, underpriced geopolitical risk.
And as you say, the geography of the excess production is perhaps more at risk than we really have grappled with in these markets this morning. Bob, thank you as ever, giving us your first take at Rapidan Energy on the response to the oil markets. Coming up, investors away. You got it. More bank earnings. It's your favorite thing. Goldman Sachs. Did they have good volatility or bad volatility? That's the question. Stock down 1% ahead of the opening call. This is Bloomberg Brief. I'm Manus alongside Danny Berger in New York. You got it. More bank earnings that are going to roll across the tape today. Goldman Sachs, the results first, followed by Morgan Stanley and Bank of America tomorrow. Joining us now, it is Saul Martinez, Senior Finance Analyst over at HSBC, our guest this morning. So, Saul, good morning. You had first flush with Citi and JP Morgan on Friday. We'll come back to those in a moment. It is Goldman Sachs, the very edification of Wall Street. Do you think they had good vol or toxic vol?
Hi, Dan. Thanks for having me this morning. I think it's a good vol. I think this is going to be a pretty good number. We're expecting $9 a share. That's a little bit above consensus, which I think is around $8.80. But there are a couple things here. One, the sales and trading numbers at Citi and JPM, relative to expectations, I do think bodes pretty well for them. Now, their sales and trading and markets numbers are a little bit different. They're a little bit more skewed to equity than fixed income relative to those, but equities actually outperformed, so I think that bodes well. And I think investment banking is going to, you saw a lot of strength at Citi and JP Morgan. A lot of that was in debt capital markets, and they are underweight debt capital markets versus those firms, and M&A hasn't rebounded just yet. But I think, there we are seeing more announced deals, and that does bode well for the second half. So I think they'll send a message that the pipelines are good in banking. You obviously had good markets, strong markets and higher asset prices. That does bode well for asset and wealth management. But I think the bigger question is about the outlook. What's the outlook for banking, especially given uncertainty on the rate backdrop, whether rates staying high for an extended period of time will impact them. Again, I think they'll highlight the strong pipelines. But, we did hear from JP Morgan that they think debt issuance was actually pulled forward a bit, and the regulatory environment for M&A remains, a bit of an uncertainty. But even then, we are extra constructive on Goldman.
Well, with M&A, regulatory-wise being an uncertainty, if rates are potentially staying higher for longer, do you expect David Solomon, for example, who most recently a month ago said he's optimistic about 2024 with capital markets rebounding, can they stay as optimistic, Saul, with all of these uncertainties that at least last year when we had inflation resurging put a brakes on the M&A market?
Yeah, I think they will stay positive. I think there's still a lot of uncertainty around the timing and the magnitude of the recovery. But if you look at investment banking activity, you are at near decade-long lows. So the direction of travel likely is higher. There's still just an uncertainty about the timing and the magnitude of a recovery. I think as long as the view is that the next rate move will be lower, obviously there's uncertainty around timing. That I think is positive. But I think they'll highlight the pipelines being strong, and also the need for financial sponsors to exit assets that they've invested in, and they also have a lot of dry powder. So there are a lot of factors that still suggest, as long as equity prices and asset prices remain relatively elevated, you'll see an improvement. But admittedly, relative to a month or 2 months ago, maybe that view is a little bit less clear in terms of the timing and the magnitude of recovery.
Saul, I'm looking at the price action on Friday of JP Morgan, down 6.5% for cash. Jane Fraser, she, had less of a drive-by. She was down 1.7% at Citi. Now, the narrative is that net interest income is a battleground that's going to become harder for these banks. Now, we seem to have sold aggressively to JP Morgan on the underheading on the NII. Jane Fraser and Citi is a bank in change. Are we in some kind of a dissipating battle of NII? Do you buy that, or have we oversold that?
I think maybe we've oversold that a little bit, but I do think there are differences by bank in terms of the NII trajectory. With JP Morgan, I would just keep in mind, though, the bar is really high. And I think the expectation was that they would increase their net interest income guidance. They kept the reported net interest income guidance at $90 billion for the full year. And remember, when they gave their guidance last time around, we were factoring in 6 rate cuts. Now we're factoring in 1 or 2 cuts. So I think there was a hope and an expectation that that would move higher a little bit more than it did. So I think I would say JP Morgan has been fairly conservative and continues to be fairly conservative on their net interest income guidance. I think for some of the other banks, there are some different drivers here. I do think that that JPM, Citi, and Wells Fargo, for that matter, did throw a little bit of cold water on the view of net interest income into the back end of the year. But some of the other banks, though, they have somewhat different drivers. And I do think you're seeing deposit costs slow down. You actually did see that in the results. Well, and you are seeing assets reprice, like fixed-rate security, fixed-rate loans reprice.
Before we let you go, because I got to get this in here, I mean, amid all this uncertainty, JP Morgan was hiring. It's not something most of the banks were doing. What did you make of that?
JP Morgan knows best. I mean, look, JP Morgan is a tremendous franchise. They're going to invest for the long term. They're not going to get near, they're not going to allow, fluctuations in the near-term revenue outlook to change that view. I do think that there's secular pressures in terms of technology competition in the banking industry, and I think JP Morgan's strength is that they do have the capacity and the bandwidth to invest quite a bit through the cycle, and I think that just reflects philosophically how they think about the world.
Saul, really wonderful to have you on this morning. Saul Martinez of HSBC. Coming up, the IMF and World Bank meeting, as well as Netflix earnings, all on deck this week. It's Bloomberg Brief with Danny Berger and Manish Cranny in New York. All right, let's get you set up for your trading week. Here's what's ahead. Former President Donald Trump's criminal hush money trial is set to begin in New York today. The IMF and World Bank spring meetings start in Washington and take place throughout this week. And Thursday, we're going to get Netflix reporting after the bell. Manis.
Yep, keep an eye on some of the micro movers. First up, we've got Salesforce. They are pursuing what would be one of the company's biggest ever deals targeting Informatica. That would boost its data capabilities. Thousands of Italians, keep an eye on Stellantis, are joining the picket lines. They're piling pressure on management in anticipation of new round of job cuts. And Tesla down 0.6%, laying off, we understand, 10% of the global workforce, Danny. That is according to Electric. Stock is down 0.6% at the moment. But there is only one story in the market, and that is oil. It's rolling over.
Price of oil down more than 1%. Bob McNally from Rapidan says there's a 40% chance of escalation, and the market is not pricing that in.
Indeed, and that the excess capacity is trapped in the Strait of Hormuz.
All right, that's it for Bloomberg Brief. Surveillance up next.